So recently there was an article in Money Control on how one aspect of or one segment of life insurance has degrown in FY25 to the extent of almost 25%. And there was also a post by the fund manager at Enam Asset Management, Mr. Sridhar Shivaram. He's well known in the investing circle. And not just the LinkedIn post, he'd also got, I think, even in a CNBC interview or 80 Now, he'd said that he's very bearish on life insurance sector and that the industry is very opaque in terms of data or how they go about the calculations behind the numbers. So we thought, as we are very bullish on life insurance, we thought it makes sense to give our view and why we think what they are saying is not true about the sector. And you can say that this is kind of a rebuttal to his post or his views. So let's get started. So this is from the Money Control article, which says that not just one insurer, all insurers across the board, HDFC, ICICI, SBI, Bajaj, their group, remember the word group, right? So group new business premium dropped 25%. So for all players, anywhere from 23 to 30% was the fall in the group new business premium. And as a result, there was a drop in the lives covered also. And even all of this put together, like for example, HDFC Life, they were covering 6.6 crore individuals in FY24, which dropped. ICICI Prudential, they were covering 5.5 crore individuals in FY24, which dropped to 4.1 crore in FY25, and so on and so forth. Right? So all of these the top four insurers put together, there was a combined decline of 4.7 crore insured lives. From 18 crore lives covered in FY24 to 13.3 crore in FY25, which is a 25% fall. This is in line with the group new business premium that we saw earlier. So that was the article. Now moving on to the post from Mr. Sridhar Shivaram. So I'm just quoting from his post on LinkedIn. He says that numbers don't move so widely in a sector unless there is a crisis. And but he does say that industry is pulling back from credit life product linked to microfinance loans, right? So any not just microfinance loans, any loan that you take, the bank will force you to take a life cover on top of that. But the interesting thing that he says here is industry is pulling back because of high mortality claims, which means number of deaths are increasing, is what he's saying. Why is the mortality high if it is MFI linked? More women are dying. Why? So these are the questions he's asking, but very strong questions, not backed by data, but by a shallow analysis, in my opinion. We'll see that in a bit. So the microfinance sector did go through a slowdown because the microfinance sector is very cyclical, right? They have anywhere from 2 to 4 year cycles. And post-COVID recovery, FY 22, 23, 24 to some extent were very good. And FY25 was the start of the first year of slowdown in MFI. And the portfolio, the entire AUM of the microfinance sector itself dropped 14%, but the disbursements that they do every year dropped 25% from 1.47 lakh crore to 1.12 lakh crore. That's a drop of 35,000 crores. Of course, this is linked to delinquencies, and that's why, because of this, because all insurers insure the microfinance borrowers whenever they take these loans. So if the disbursement itself has dropped 25%, the cover and hence the premiums also should drop by 25%, right? Which is in line with what's happening in the underlying sector. First, we have to understand how the numbers work. Right, so the drop was 35,000 crores in FY25 in the disbursement at the sectoral level. And microfinance, a single ticket size loan is anywhere from 10,000 rupees to 40,000 rupees, depending on which cycle of the microfinance each borrower is in. Like if you're in the first cycle, you'll not be given a loan more than 30,000, and even that will be given to you in stages, stage one, stage two, stage three. And if you're in the second cycle, you'll be given a loan of say 20,000 to 40,000 rupees. So your overall microfinance borrowing will in the second stage will be roughly around 60 to 70,000 rupees. And in this third stage, you're a mature borrower. So micro lenders usually give you a loan up to 1 lakh crore. So from the 70,000 in stage two, sorry, 1 lakh rupees, right? So from 70,000 rupees loan that you had in stage two, you will go to stage three with incremental borrowing of 30,000 rupees. So this is how MFI lending works in stages across the vintage of the borrower. So let's say 35,000 crores was the drop in disbursement in microfinance sector, and assuming each disbursement, each ticket size is 10,000 rupees per borrower, that itself is 3.5 crore borrowers. And most of these are renewal policies, which means insurers could have chosen to not to renew the policies that they had given in the previous year as well, not just FY25. Right. So the drop in lives covered can easily be 5 crores, 7 crores, 8 crores, depending on the specific insurance company and how much they wanted to withdraw from the sector. And this is not the first time that this is happening. In the past, also, let's say life insurance companies were heavy on ULIP, unit linked insurance products. Some of them chose to stay away from it because of the volatility in the market and because of the lack of demand from the insurance customers. Right. So there are always pockets where insurance companies move in and out of a segment because of the temporary issues or the sector specific issues in that in those segments, right? So we can't read too much into it because the contribution of MFI, or if I forget MFI, at least the group business to the overall business of life insurance companies itself is very less, that we'll see next. So I wanted to, back my thoughts or rebuttal with data. So this is HDFC Life's data from FY20, which is the financial year just before COVID, and I've taken both FY24 and 25 because that's the discussion. Those are the two financial years under discussion, right? And if you see the premiums, even though group new business premiums have dropped, the total premiums continue to grow. Forget the 5-year CAGR, which is anyway is good. Just a second. The 5-year CAGRs are too good, right, for the company. Even the year-on-year numbers, despite the drop in group new business premiums, the overall, so new business is when you write a new business, but total premiums will include all your old premiums which come for renewal and the new premiums. So that has anyway grown at 11%. And group premiums contribute only 50% to the overall premium mix. And if you see the number of lives covered, that we've already seen that the group life cover has fallen by 25%. But the individual, which is more important, the number of lives covered has grown at 9% year on year, which means they managed to find 9% new individual customers for their uh, premiums, right? And next is, so what constitutes this total premium? Total premium is nothing but number of lives covered and the premium per life, right? So this 15% can be broken down into two segments. One is 9%, which is the growth in the number of lives covered or policies, you can say, and 6%. So 9% plus 6%. 6% is the premium per policy, which means the same borrower or same insurance customer is now paying a higher premium for the same policy compared to the previous year. So this 9% plus 6% is what constitute this 15% growth, the total premiums for HDFC Life. But total premiums doesn't matter at all. Forget the group new business. I'm saying total premium still doesn't matter because most of it is uh, renewal premiums. And what we have to look at is something called as APE, which we'll get to in a bit. Another important metric when it comes to life insurance is the sum assured, right? And that keeps going up. For example, pre-COVID, each insurance buyer had a life cover of almost 26 lakhs, and now that has gone up to 34 lakhs. And that's why you see the jump in the premium per policy. So one policy was worth 94,000 in FY20, and it's now gone to 1.33 lakh. This is the life insurance policy, not your health insurance policy, which typically is around 30,000 rupees, 40,000 rupees, and so on. So what this means is that, and sorry, so some of you might have, or even all of you might have life insurance covers, and I'm sure they might be higher than this figure, say 34 lakhs. I personally have a life cover of 2 crores, right? So most of us will need much higher covers going forward, and this means that this number will only keep going up. Compare this with the group sum assured. It's just 2 lakhs because, like I said, for a microfinance borrower, the entire loan amount itself will, if you're in the first stage, it will be 40,000 rupees. If you're in the third stage, it will be 1 lakh rupees. So the cover needed for a single microfinance borrower is much, much, much lower compared to the individual policy. And this is 2 lakhs because group policies is not just microfinance, there is home loans, there are other types of loans which also come with credit life protect. Basically, it will be linked to the loan amount and not what the insurance customer wants as a life cover, right? Banks just want to, if the borrower dies, banks just want to ensure that they get paid their principal back. So the insurance cover will be limited to the extent of the loan amount. That's why it's much lower. So our thesis is that one, the number of lives covered in the individual policies will keep growing up. 5-year CAGR is 7%. FY25 growth was 9%. And each of these lives covered will take higher, it will pay higher premiums. And that's also again seen in the 5-year CAGR of 7% because they're paying higher and higher premiums because they want higher sum assured. Right, so both of these will contribute to the top line of HDFC Life, and uh, because of this group life's smaller impact on the overall top line or the business metrics of HDFC Life, we feel that looking at a particular individual segment within the overall mix doesn't really give a proper analysis. It's more shallow in nature. So another claim that he makes is that women are dying. He's, of course, not a claim, but he's questioning if more women are dying in the country and if mortality has gone up compared to pre-COVID. And if you see here, in fact, so if you compare, if I forget pre-COVID, just take FY24 versus 25, there were 4 lakh deaths reported to HDFC Life, and the number was even lower in FY25, less than 4 lakhs. So fewer people have passed away. Uh, This is just from the customer base of HDFC Life. So there is no, if mortality had increased, this 4 lakh number should have gone up to say 4.1 lakh or 4.2 lakhs number of people who have passed away, right? So, and that's not significant. Even in the individual, the number of lives or death claims made to HDFC Life has grown only by 2%. Of course, there is a jump compared to pre-COVID, but in FY25, only 2% incremental deaths were there in the HDFC Life's customer base. And because we saw in the previous slides that uh, the sum assured has gone up compared to the pre-COVID levels. The death claims paid, the amount paid per death has gone up significantly higher in the last couple of years or post-COVID, you can say, because as you see, that's a 26% CAGR. Although the number of lives that were claimed is only 9%, the total amount paid by HDFC Life for all those death lives has grown at 26%. Again, so you can see the breakup. Lives is 9% plus claims paid per death is 15%. So mortality has not increased. It's just the claims paid per death has increased, and that's a function of the sum assured and nothing to do with mortality. And if you see deaths by the number of lives covered, that has remained fairly stable, some 1.4%. So let's say HDFC Life had covered 100 lives in FY20. Of that, there were death of 1.4 customers, right? And similarly, for every 100 lives covered in FY25, there were deaths of 1.6 lives. And this jump that you see, 0.6 to 0.8 in group life covers, is because of the lower base, because the lives covered, which is the denominator, has come down by 25%. That itself would have increased this 0.6 to almost 7.75. And of course, there are slightly higher than that. And another way to look at this is one way of reasoning could be that the insurance companies weren't collecting enough premiums for every death claim. So that is, they've corrected that, right? From sum assured, of the sum assured, let's say 100 rupees, 1 crore is the sum assured. They were collecting only 3.6 lakhs as premium in FY20. Now they, for every 1 crore of sum assured, they're collecting almost 4 lakh rupees. So they've corrected that to some extent, but they've, what has changed significantly is they've corrected their group premiums. So they were actually not collecting enough premium for the kind of risk that they were taking. For every, say, 1 lakh cover of life in FY20, they were collecting only 1,300 rupees as the premium. Now that's jumped almost 50% to 1,800 rupees per 1 lakh of cover, right? So this argument I'll accept, where the life insurance companies weren't collecting enough premiums for the kind of risk that they're taking. Risk here is sum assured in case of death. And that's also reflected in claims paid by premium collected. So they were uh, earning a lot because the premiums were lower. And if you, so let's say 100 rupees is the premium collected by HDFC Life. They were paying only 12% of the premiums collected as claims. Rest 88% will be given as commissions to all their distribution partners, and finally the margins that the company makes. Now that 12% has gone up to 17%, which basically means their expenses have gone up 5 percentage points, but they're still profitable, right? So even if this 17% inches up to say 20-25%, they still have 75% of premiums collected every year, which they can distribute as commissions, and post that whatever is left, they'll take it as profits for that particular year. So it's not alarming, right? The claims paid per the premium collected. So the important metrics in life insurance is APE, annualized premium equivalent. So there are three types of premiums in life insurance. One is first year premium, which means a new customer buys an insurance policy, he pays the first year premium. Then there are renewal premiums. Uh, People who have already bought an insurance policy, they'll continue their policy by paying premiums every year. Basically, they are renewing their policy. Those are called as renewal premium. Then there is something called a single premium, where some insurance customers, they don't want to pay premium every year. So what they'll do is they pay all the premiums upfront as a single payment. So that's called single premium. So to compare on a year-on-year basis, or to compare between insurance companies within the same sector, the more appropriate metric to track is the APE, which is first year premium, which is anyways a new customer coming to the company, and 10% of single premium. So you're basically amortizing the single premium over a period of 10 years. So that will give you a good idea of how much new business that a company is generating, because renewal is always there, and given the persistency, given the renewal rates of almost in group, I think almost 90% is the renewal rates. So you don't have to worry about the renewal policies. What you have to focus is on new policies given out by or sold by these insurance companies. And of course, we did talk about sum assured and VNB margin. AP is important because it directly feeds into the calculation of value of new business, which basically VNB is nothing but, let's say they have 100 rupees of premiums sold every year. What is the margin or the profitability that they make on those policies sold? So for HDFC Life, the VNB margin today is roughly 25%, which means for every 100 rupees of new APE, they make 25 rupees of profits. So my view is that looking at total premiums and lives covered will be misleading because of this skew that you see in the number of lives covered. In terms of total premiums, 50% comes from individual, 50% comes from group, more balanced. But in terms of number of lives covered, individual is only 3% and group lives is 97%. So any drop in this group lives will look alarming, uh, but it's not the case. There's another metric that I want you to look at, which is, so we saw that in terms of total premiums, individual and group are balanced with 50% mix. But in terms of APE, individual is almost 88% of total APE, which means group premiums are mostly renewal premiums, right? Because any company that you're working at will have already given you a cover on all these loans, are well penetrated. So that will only be mostly be renewal premiums and not new premiums. So all the APE is coming, or most of the APE is coming from individual premiums, and it constitutes almost 88% of total APE. So summary, there is no crisis as mentioned by Mr. Sridhar Shivaram. It is a temporary slowdown in one of the segments which doesn't contribute much to top line or bottom line. And I feel that it was a shallow analysis of looking only at group business numbers and not the overall pictures. And even if you look at the overall, I think we should look at APE and not just total premiums or total lives covered. So claims is higher than pre-COVID because of the higher sum assured. Every customer wants more and more cover for them, for themselves, for their family, and not because of mortality. Right? There's no significant, of course, FY 21 and 22, because of COVID, there was increase in mortality. But otherwise, there's not significant increase in mortality, and this was also confirmed by HDFC Life in their recent con call. So why do we like uh, life insurance as a sector? So this, you can say that life insurance is a young adult because the industry itself was started in early 2000s. So it's like the industry is just 25 years old compared to India's 75 years, right? So this is a very young sector, and the growths so far have been pretty high, right? You can see that between FY 15 to FY 24, the sector itself, the new business premium sector itself grew at 11.5%, and total premium grew at 11%. And sum assured grew higher than 15%, which means as our per capita income increases, people want more and more cover, right? So this is like a continuous flywheel for life insurance companies where even existing customers want higher sum assured for them. Penetration and density, a lot has been talked about this. Of course, we are very similar to where China is, but there's still room compared to the developed countries, and that is mostly driven by the life insurance density, which means basically insurance cover per person. Right? That's even lower compared to China itself. So even if everyone has a cover now, but the cover is not sufficient, right? That's what uh, this life insurance density indicates. So because of this, life insurance premiums are projected to grow at 9% CAGR over the next decade also. So sum assured as a GDP is very low compared to even the other Southeast Asian countries. And as you can see, even that sum assured is mostly savings related products, the par participating products, non-par products. But the protection sum assured is even lower. So this piece will keep growing at a much faster rate than this 9% that we just talked about. Not just protection for working people, even for people who are retired, already have or closer to retirement, they rely on pension assets for their retirement life, right? So that even that pension assets as a percentage of GDP is very, very low compared to other countries. And we are an aging population. Today, we are reaping the benefits of our demographic dividend. But over the next course of next 10, 20, 30 years, our population will only become older, not younger. So all of them, all of us will need pension assets going forward. This is the best part of my thesis on life insurance. We've seen that because of increase in mutual fund assets, because of people, more and more people coming to the markets, the exponential growth in demat accounts, the deposits have taken a hit, the bank deposits, right? So that's seen in this blue figures from 67%. The share of currency and deposits in the overall financial savings has come down to 44%. But despite the growth in share and debentures, if you, this is the dark blue one, that's grown from 2% of the mix to 9%, which means it's grown exponentially. But insurance, which is the red piece, has managed to maintain its mix within the overall financial, which means, of course, people are moving to mutual funds and equity, but the money is coming from their bank deposits and not from the insurance that they were buying. So they people are still continuing to buy insurance, and that I think is our one of the biggest reasons why we are bullish on life insurance. And HDFC Life, so we have seen that the sector itself grew at 11.5% in the last 10 years, and HDFC Life has grown at almost 20%. Uh, This is in terms of value of new business, not premium. At premium level, they would have grown faster by 3-4%. Like if the industry has grown at 11%, HDFC Life would have grown at 15%. So this is the best company in the sector, and that's why we want to own HDFC Life. So if you see, for all banks, we look at return on equity, but for life insurance companies, it's slightly different. There's something called as ROEV, which is return on embedded value, right? And that's for FY25, it was 16.7%, which is very good, right? Because even for a decent bank which makes 14-15% ROE, we are okay to pay. The market itself gives 2 to 2.5x price to book. But for the best life insurance company, which has 16 to 17% return on embedded value, shouldn't it trade at 2.5 times its embedded value? And that's where HDFC Life is currently. Maybe now it's closer to its all-time high, so it sort of slightly gone up. This is 1 year forward price to embedded value. So this piece that the bottom end of this range, which is closer to your 2 times price to embedded value, is when we started buying into HDFC Life in a big way. That's where we started building our position. And we are significantly overweight in HDFC Life. For example, in the Nifty 50 index, HDFC Life has less than 1% weight. But whereas in True Blue, which is our Nifty 50 product, we significantly overweight at almost 7-8% of the portfolio is in HDFC Life. So that's our thesis on life insurance. So happy to take any questions that you might have on what we just discussed or anything related to life insurance.